Coforge just dropped the blockbuster Q4, 30% growth, record 16.6% EBIT, and a $1.75 billion order book. Is this the start of a massive re-rating? To understand how Coforge is outperforming, we're diving into 4 key pillars. First, we'll analyze the top-line growth and the bottom-line reality of their numbers. Then we explore the engine, specifically the segment winners and the AI catalyst. We'll also check the foundation's health through cash flow and the balance sheet, before ending on the final verdict on risks and the FY27 outlook. The revenue momentum is undeniable, hitting 4,450 crore rupees. This represents a 30% increase year-over-year, driven primarily by strong volume growth and the strategic Cigniti merger. On the margin front, we're seeing a breakout with 16.6% EBIT, an all-time high for quarterly profitability that sets a massive stage for future visibility. Taking a closer look at that 4,450 crore revenue, the quarter-over-quarter growth stands at 5.2%. The primary engines under the hood are the strong volume momentum in the travel and healthcare sectors. Additionally, the successful integration and immediate impact of the Cigniti merger have provided the scale needed to push these record numbers. It is important to look past the headline numbers. While the reported profit after tax jumped 144% to 612 crore, it was inflated by a one-time tax credit. By removing the 181 crore Cigniti deferred tax reversal, a non-cash credit, we find the true operational earnings. At a normalized 431 crore, the underlying earnings remain incredibly strong and healthy. Coforge is benefiting from a serious operating leverage kick. EBITDA reached 20.6%, up over 345 basis points year-over-year. This was driven by targeted reductions in SG&A and a boost from improved employee utilization. These efficiencies provide a formidable exit run rate as the company transitions into the 2027 fiscal year. Not all segments are equal, and right now, healthcare and high-tech are the hyper-growth stars, with over 78% growth. Travel remains a massive engine, growing at 59% thanks to the Sabre deal impact. Meanwhile, the BFS sector acts as the steady giant, with 24.9% revenue share, and insurance is showing rebounding momentum with 14.5% growth. The fuel for FY27 is already in the tank. Coforge signed 5 distinct large deals this quarter, bringing in $648 million in fresh intake. This brings their 12-month executable backlog to an all-time high of $1.75 billion. This level of visibility essentially guarantees the revenue baseline for the coming year. The One AI platform is a central part of the strategy, shifting the company toward an AI-native engineering core. They aren't just talking about it. They invested 46 crore strictly into AI training in FY26. This investment is directly driving the operational efficiencies we see in those 20% plus EBITDA margins. Profits are only as good as the cash they produce, and Coforge is converting at a high rate with a 76.3% FCF to PAT ratio. Q4 saw the strongest cash generation in company history at over 671 crore. They've maintained this healthy ratio even while making heavy investments in the Sabre deal and their AI infrastructure. The company is deleveraging rapidly. Total debt is down to roughly 400 crore from 659 crore in the previous quarter. With a debt-to-equity ratio of just 0.04 and cash equivalents exceeding 1,000 crore, the balance sheet is extremely healthy. Net worth has also expanded to over 9,600 crore via accrued profits. Operational KPIs show an engine running at high performance. Utilization is up to 82.5%, showing efficient workforce deployment. Crucially, attrition is at 10.8%, the lowest in the IT industry, which reduces the drag of hiring and training. With 95.5% repeat business, client intimacy remains incredibly high. The catalysts for FY27 are clear. Management expects margins to hold the 16.6% exit run rate. The Crore integration is expected to add over $170 million in ARR, supercharging the healthcare vertical. Most importantly, AI is beginning to decouple revenue growth from headcount, allowing for non-linear scaling. However, there are red flags to watch. Client concentration is high, with the top 5 clients contributing nearly 22% of revenue. There's also the risk of integration overload from managing both Crore and Signiti at once. Investors should also note that future PAT will revert to a higher tax rate without this quarter's one-time cushion. Final verdict. The stance is constructive. Coforge enters the new fiscal year with a formidable $1.75 billion backlog and strong margin guidance. If they can successfully navigate the dual M&A integrations, the AI-driven operating leverage provides a massive tailwind for the stock. If you found this Coforge earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.